Good morning, everybody, and welcome to our first of hopefully many webinars. And this morning, we're going to be dealing with something quite hot on the lips of the accounting world at the moment. It's something that a lot of people have been asking questions about. It's something that's going to affect a lot of people, which I'll go through, and that's the IFRS 16, the new standard on leasing. My name is Michael Steenkamp. I'm one of the directors for RSM South Africa, and also head up I'm also the head of IFRS for RSM South Africa. Yeah, that's just a quick introduction. For those of you who are participating, thanks very much for tuning in and to listening this morning. There is an option to raise questions and answers at the top on your screen. If you want to raise a question and answer, I'm not going to answer them as we go along. I will try, if we have time, to answer them at the end, and then we can go through those. If not, and there are still questions that are unanswered, please raise your questions still, and afterwards I will get a list of those questions and I will then respond to all participants via email or something like that. If there is something that you want to know specifically, please feel free to give me a call or to email me afterwards if there is anything that you're unsure about. So let's get into it. Like I said, this is a discussion and a webinar. We will do it in the half an hour allotted time. But what we're going to be covering is the new leases standard, and that's IFRS 16. It is quite a high level overview of the standards and the requirements. It's not a very difficult standard to understand. The first bit of the presentation is going through understanding the standards, what the requirements of the standard are, the initial recognitions, subsequent measurements, and things like that. And then I'll run through a very simplified case study, just kind of explaining and setting out the requirements of the new standard. Like I said, this is a standard that really is going to affect everybody, from the smallest company that rents a photocopier to a large company that's got hundreds of leases for various things. Very important just to note that before we get started, that this is specifically to the lessees. Lessor accounting in the main has remained pretty much unchanged from that of the current leases standard IS 17. So lessee accounting is what is changed significantly, and that is what I will be dealing with. So if you are a lessor, things like the how you're applying the accounting requirements to your leases at the moment is pretty much going to remain unchanged. But for most of us, we lessees, and this is going to affect you guys quite significantly. So just flowing into it and just looking at some of the definitions, and look, there's only really two definitions that I'm dealing with, and the one is, what is a lease? A contract is or contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So pretty straightforward. It's the right to you have the right to use a specific asset, and you pay for that right to use it. Just a very important point to note is I've highlighted there is the word control. Control is very is a concept that has been coming up time and time again. It came up with IFRS 10, the consolidation standard, where this whole identifying who controls a subsidiary. It came up again now in the new revenue standard, revenue from contracts with customers, being IFRS 15. They speak about control and when revenue can be recognized. So again, we see it in IFRS 16, and it's the right to control the specific assets is whether or not there is a lease. If you as the customer has the right to control the asset, then it is a lease. If the supplier has the right to control the asset, then it will be seen as a service, and then it's not a lease, and it's out of the scope of IFRS 16. You as the customer has the right to control the asset if both of these are present. Firstly, you have the right to direct the use of the asset, and we'll go through each one of these now. And also, if you have the right to obtain substantially all the economic benefits from the use of that asset. Okay, so just breaking down the definition and looking at the different aspects. What is an identified asset? An asset can be identified in a contract either in two ways, either if it's explicitly or implicitly. So explicitly refers specific to a specific asset with a specific serial number or registration number or something like that, or implicitly it can be like that example says, there a specific part of a piece of equipment with a specific serial number. Something very important, which is probably the one thing that in practice to date that I've seen so far that has quite a lot of debate and quite a lot of judgment involved in, and which is something that's important to look at in your lease contracts and things like that, is that an asset in a lease is not identified if the supplier has a substantive right to substitute that asset throughout the period. So there are the three criteria there that we'll go through, but what that pretty much means is if the supplier of the asset that you're leasing has able to right to substitute that asset throughout the period, then obviously you don't have an identified asset, and then you don't have a lease. So the supplier has the practical abilities to substitute that asset, and then that means you as the customer cannot stop this from happening, and these assets are already available to the supplier. And then also the supplier would have to benefit economically from the substitution, and the substantive substitution right is something that you determine at the beginning of the lease, at the inception of the contract, with facts and circumstances available at that date, not later on, and it's at the inception of the lease. And so that's why I'm saying it's very, very important to look at, when you're entering into lease agreements, whether or not the supplier of whatever equipment or asset that you're renting or leasing has that substantive right to substitute that asset. What do we mean by economic benefit? So you as the customer is required to have a substantially, to receive substantially all the economic benefits from the use of that asset throughout the period. What are the benefits? So firstly, and I think the one which would be most common is the exclusive rights to use that asset. Secondly, if you've got the option to sublease that asset, and then also any primary or byproduct or cash flows from that asset. So that's the economic benefits associated with the asset that's got to be present as well for there to be a lease. So we've gone through the definition. You have to have a right to use an identified asset. How you identify assets is important, and also you have to receive the economic benefits associated with that asset over the lease term. So that's pretty much, in a nutshell, what is lease in terms of IFRS 16. Now I'm just going to go through how we measure the lease the rights of use assets and the lease liability. Firstly, the standard talks about the starting point for the calculation and for the recognition of a lease is the lease liability. So the lease liability is the starting point, is the first credit, and later on within the debit to that is amongst other things the rights of used asset. But the lease liability is pretty much a straightforward calculation. It's the lease payments, and we'll go through each aspect, being the lease payments, the lease term, and the discount rate in slides to come. But the lease payments, what that is, so your lease liability is the lease payments over the lease term at a discount rate. Quite straightforward. What the discount rate is quite important to know, is either if it is readily determinable, is the rate implicit in the lease. I have not seen that too often in practice, and most people are going for the lessee's incremental borrowing rate. What that means is, what is the rate that you as the customer could lend money from your your finance providers to buy a similar asset over similar terms. So that would be the lessee's incremental borrowing rate that would be used as a discount rate if the rate is not available in the lease. Payments it could get a little bit complicated. It's not too bad, but it's not just the fixed payments that are involved or that are stipulated in the lease agreement. So that is the starting point. So most lease agreements would say you're going to pay 10,000 Rand a month for 60 months. That's great, with an escalation. So that's the starting point. The second thing to include in your lease payments in part of in the calculation is of variable payments that depend on an index or a rate, so a escalation or a CPI or something like that. Very, very important to remember is that those any variable payments that are dependent on sales of the underlying assets are not included as lease payments. So often we would have the case where you have a lease agreement and it's for a piece of equipment, and you say, okay, pay me 10,000 Rand a month, and 1% of any sales from asset or from stock produced from those machines a month as well. That 1% so is dependent on the sales, so that is not included as a lease payment in calculating your lease liability. And then obviously a lot of leases have an optional payment at the end, being a residual value guarantee or a purchase option. What's important to know, those aren't automatically included. It's if they are not reasonably certain to occur, then you won't include them. But if you pretty much know that at the end of the lease term, you're going to acquire the assets and you're going to pay the extra residual value or purchase option price, that would, if you're reasonably certain that it will occur, then you would include it in your lease payments. If not, then you would not include it. So there are certain things to think about. It's not always included or excluded. It is important to know, especially at the beginning of the lease, what the intention is in making these payments. The lease term is also something that I've come across in practice in meeting with clients and discussing these, and that is the lease term. So the lease term is where I've come across the most judgment, and there's various clauses in leases that could make this, that could change the lease term quite significantly. First and foremost, the easiest part is the non-cancelable period. So we know we rent, we enter into lease for 5 years, 3 years, 4 years, whatever it might be, 10 years, and that's quite straightforward. So, and we know what that non-cancelable period is. The tricky part, in truth, comes in with what we refer to as is the extension period. And we would include the extension period that the lessee is reasonably certain to exercise. So if at the inception of the lease, the lessee is reasonably certain they will exercise the option of, to extend the lease, you would include that extension period in your lease term. There are certain factors that we need to consider in determining whether or not it's reasonably certain. We can't just say, oh no, we're not going to extend our lease term. And it's not just that simple. There are certain indicators and considerations to take into account, those being something like the level of rentals in a secondary period compared to what you would pay in the market, any contingent payments that you might have to pay, or any renewal or purchase options of the assets, the cost of terminating the lease and signing a new lease, the nature of the assets, the location of the assets. It's not as easy if you're renting a big warehouse, for example, and it's got all your inventory in, and you want to lease another warehouse. Is there another? Is that the best location? Is there a suitable warehouse in another location? The availability of a suitable alternative. If this is a specific asset for you, are you able to, like the warehouse example, is there another warehouse available for you to move to? If not, chances are you are going to extend that lease. And it's not just as simple as saying it's the non-cancelable period. If you've spent significant amounts of money on leasehold improvements, chances are you are not going to leave those premises if you've incurred those costs and those expenses, because you've invested the money, so you probably will extend. So those are things and indicators that you would need to consider when determining whether or not it's reasonably certain that you would extend the lease or not. We'd also include any period that would cover the option to terminate, where it's reasonably certain that the lease will not be terminated, where the lessee, will not terminate the lease. So often a lease would be for a 5-year period, and you've got the option within the last 6 months to cancel the lease or terminate the lease. If you're reasonably certain that you're not going to terminate the lease, you would include that last 6 months. So that's the lease term. So now we've got our lease liability, we've calculated, we've gone through what the lease payments are, we know what the lease term is, and we then know what the discount rate is, and then that's the calculation that we get to our lease liability. So looking at the lease asset, what it's referred to is actually a right of use asset. It starts, like I said, to the lease liability. You'll see that in the journal entries in the case study that I will do now. But it starts with the lease liability. Next, you would add to that any lease payments that you've made at or before the commencement date, and then you would deduct any lease incentives that you might receive for signing the lease. And then any initial direct costs you would also include in the cost of the asset. And then any estimates of costs incurred by the lessee in dismantling or removing the underlying asset. So those are things that would go into the cost of the assets at initial recognition. Subsequent measurements, if you've got a right of use asset, is similar to any other non-current asset. You would depreciate through profit and loss, and you would assess it for impairment. The lease liability, similar to any other financial liability, you would have your interest through P&L, which would be the discount unwind from the initial recognition. You would also reassess your lease liability annually for any changes, any possible changes in the lease term that might have happened during the year, and also changes in cash flows due to a change in index or rate. So if there's a change in the CPI or another index or whatever it might be, you would also change those. You would also reassess your liability if there's a change in those. And then also you would account for any lease modifications as and when, if those do occur. That's not all bad news. There is some good news. There is two areas of good news out there for lessees. The one is what we refer to as a short-term lease. That is a lease that is less than 12 months, is the one exemption. And the other exemption is for a low-value asset. Just to be clear, this is a per asset assessment, not so you might enter into a lease for 10 desktop printers. Each printer is less than $5, which is what you look at. $5,000, sorry. So that is what you look at, not 10 times 10 in one asset. So you don't look at the lease value, you look at the asset per asset value. So for the first time ever, a standard, or this is actually in the basis of conclusion of IFRS 16, the ISB has given us a guideline of what would qualify as a low value asset. And they've used the amount of $5,000 US. What we would do, obviously in South Africa or anywhere else in the world, is you would translate that at the exchange rate at the date of entering into the lease. Examples of those are like your laptops, office furniture, telephone. Assuming it's a 14 US dollars to the rand, 14 rand to the USD exchange rate, it would be 70,000 rand kind of area that you would look at. For those leases, we would account for those as we currently accounting for any lease under IFRS 17, simply just recognize the lease payments as an expense through P&L. What is important to note is for the short-term leases, I've had this question a few times actually, is you can't, if you've got a building that you're leasing, for example, and you've had a 10-year lease, you can't now change that lease agreement with your landlord and say, okay, I'll sign a new lease every year and have 12 short-term leases. You can't do that. What's important to know is that you've got to take those assessments for the lease term, or the likelihood of you moving and extending into account. So it's not just that simple, and we need to apply those principles in determining the lease term. So yes, it's for those genuine leases where it might be for a short period of time that you might need for a specific purpose, and you're not going to keep them for the long term. So those are the two optional recognition exemptions. Like, they are optional, they're not compulsory, but I would assume a lot of people take up those options. Effective date is around the corner. The effective date of this is 1 January 2019. So that means anybody with a December 19 year end will be your first year end, will be the first year ends that apply this standard. However, we're doing this now. We've done a few presentations on this before. I've written a few articles on it. What's important to know is don't leave it till then. Don't leave it till next year this time to start thinking about your December 19 year end, because anybody preparing IFRS financial statements will know that there is that new standards and interpretations disclosure that we've got to include in the financial statements. So, and obviously we've got to disclose the impact of what IFRS 16 is going to have in that note to the annual financial statements for December 18 already, or whatever year end you will be ending during the course of next year. It's not appropriate to, I know most cases last year for December 17, for example, customers would have said, or clients would have said that the impact is still being assessed. We can't say that for 2 years in a row. Questions are going to be asked that for 2 years we couldn't have been assessing what the impact of IFRS 16 is, we should know by now what the impact is going to be, and that impact should be disclosed. So it's something that we should start working on at the moment. What I'm going to go through now is the transitional provisions. There are two options. Both of them equally, I will add, are equal amounts of work. I think option 2 is what will be taken up the most, because I do believe that it is easier with regards to the disclosure of financial statements, which you'll see now. But I believe that the work to go into determine the impact of IFRS 16 is the same in either option. Option 1 is a fully retrospective application. That means if you restate your comparatives as if IFRS 16 was always applied, and you provide line-by-line comparison disclosure. So that you go back, IFRS 16 was always there, to forget about IFRS 17, and you do a full retrospective application in terms of IFRS. That would be 3-column balance sheet, all of those things in terms of the relevant IFRS standards. Option 2 is what they call a cumulative catch-up. So you obviously got to do your calculations either way, but you leave last year's figures as they were reported in your financial statements. You adjust your opening retained earnings on transition. So what that means is you would have a line item in your statement change in equity that would say as previously reported, and that would agree to your prior financial statements, and then you would have impact on from adoption of IFRS 16 on retained earnings, and you reconcile it there. And then, but obviously there will be additional disclosure that will need to be provided on data transition if option 2 is selected. There is a practical expedient available. So for any leases that you have terminating or ending within the next 12 months, you can ignore and roll those out as you have been if you have identified those as an operating lease. So going through the case study briefly, this is where we are. I've gone through a very high-level overview of what the standard requires, but I'm sure, as you can see, it's not a very complicated application, but determining lease terms, determining what the lease payments are, is there a lease, is there an identified asset, could get a bit tricky. So we just need to apply our minds when looking at those, and then obviously recognize the necessary liability and necessary assets accordingly. So I'm going to go through a very high-level example, setting out what the journal entries are and what the calculations are, and hopefully it becomes a bit clearer in an example. So let's look at the scenario. Lessee A enters into a 5-year lease on a building. To obtain the lease, Lessee A incurs initial costs of 30,000 Rand, made up of 20,000 Rand payment made to the former tenants occupying the property, and the remaining 10,000 Rand was paid to an estate agent for arranging the lease. Great. The lease sets out a minimum lease term of 5 years with an option to extend it for a further 5 years. For purposes of this example, we're going to assume that it's not likely to extend, just to keep the calculation simple. So our lease term there will be 5 years. The payments are scheduled as follows. For the first 5 years, we pay 50,000 Rand per annum in advance. Optional period, which is not applicable in this example, is 55,000 Rand per annum in advance. In practice, however, we know such payments are likely to be paid quarterly or monthly, in most cases in advance. However, for purpose of this case study, we're going to assume that payments are paid annually, just to simplify the illustration. So initial recognition, step 1. We need to determine the lease liability at the commencement date of the lease at the present value of the minimum lease terms at the discount rate. We're assuming that our discount rate or our interest rate is 5%. Remember, I did explain this earlier. If readily determinable, it's the rate implicit in the lease. Otherwise, the lessee's incremental borrowing rate. So there it is, just simple present value calculation for our lease liability. So our lease payments over years 2, 3, 4, and 5 of 50,000 Rand, discounted, get to a present value, getting to a total lease liability of 177,300. Step 2, we need to determine the right of use assets at the commencement date. As you can see, we start with our lease liability of 177,300. So the first, plus we'd add our first lease payment, which is made at the commencement date of 50,000 Rand, our direct costs, which you said we could include, of 30,000 Rand, and we're assuming we received a lease incentive of 5,000 Rand, which we would deduct. giving us a total rights of use asset of 252,300. Just to show this, as accountants, we like seeing journal entries. There is the journal entry on initial recognition to set out the assets, to recognize the assets and the liability. We have a debit of right of use assets of the 252,300, lease liability of 177,300. We have a bank, then obviously the bank account, we credit for the lease payments and for the indirect, for the direct costs, the initial direct costs, and then we would have a debit for to the bank account for the 5,000 Rand lease incentive. So that's a very simple sets out journal entry on initial recognition of our property lease over 5 years. What do we do next? So subsequent measurements for our rights of use assets. If that asset is on the cost model, we would account for it at accumulated, it would be cost less accumulated depreciation and impairment losses, and like any other assets under IFRS 16 being the PPE standard. So if something just to remember, if you are going to take ownership of the asset at the end of the lease term, so if you've determined on initial recognition that you probably will take ownership of the asset, then we need to depreciate the assets over its useful life. So ownership of the underlying asset, like I said, is going to transfer at the end of the lease term, or it's reasonably certain that you will exercise the purchase option, then the right of use assets will be depreciated over the useful life. You would depreciate it over the lease term if in all other circumstances, so you're not going to, not likely that you'll take ownership, or ownership doesn't automatically transfer at the end of the lease term, you would depreciate that asset over the lease term in accordance with IFRS 16. Interesting, if your right of use assets is on the fair value model, so if it relates to investment property, you must measure your right of use assets at fair value as well. If the right of use assets relates to a class of PPE that you apply the revaluation model to, then the entity may revalue the right of use assets as well. Very important to see the distinction. It's a must. If it's a must measure the right of use assets at fair value if it's investment property. It's a may revalue the assets if it's a right of use asset that's under PPE on the revaluation model. Your lease liability is pretty much straightforward. You start with your carrying amount, you increase that to reflect the interest, the annual interest, the unwinding of the discount, and you would reduce it to reflect any the lease repayments, similar to as you would now for any finance lease, really. The remeasurements, you would also remeasure your liability subsequently to reflect any reassessments in the lease or any changes to the due to lease modification or whatever that might be. So yeah, that's very simply an example that I've just gone through a case study setting out the requirements of the lease standard. I see there have been a few questions and answers that have come through. We have run out of time almost. There's a minute left, so I will look at these questions and I will go through them and I will respond to them via email, and I'll include everybody on the email just in case everybody listening might have had the same question or not. So there will also be a recording available of this presentation that will be made available, and we'll also load it up on our RSM YouTube channel. If you're not following that, feel free to go find us on YouTube, and you'll also be able to see previous videos and things that we have uploaded, and also this one will be made available there as well. So yes, please feel free to drop me an email, give me a call if anything's unclear. If you want me to come meet with you, we can go through a couple of your leases. I know some clients have hundreds of leases, so if you want me to just get the ball rolling and going through a couple, I'm more than welcome to help with that. Please feel free to get hold of us, and thank you very much once again for your time and your attention, and look forward to hearing from you. Thank you very much.